It's been a bumpy ride for markets amid a global sell-off in government bonds. The yield on the 10-year Treasury note recently hit 4.8%, and the 30-year bond passed 5%, both the highest since the financial crisis.
Markets' concerns about inflation, that is driving up bond yields in the US. It's possible that bond yields could hit higher. Some market experts think that it could hit towards a 5% level or even higher, which I think is a possibility, as long as inflation in the US remains high.
Bond yields affect everything from the stock market to the cost of borrowing. So what are bond yields and why do they matter? Let's start by looking at what Treasury bonds are. Treasuries are a type of loan where investors lend money to the US government for a set period of time. In return, investors are paid interest, known as yield. It's the annual return an investor earns by holding a loan until its maturity date. There are three types of treasuries. Bills have a maturity of less than a year. Notes have a maturity of 2 to 10 years. And bonds mature in 20 or 30 years. Typically, the longer the maturity, the higher the yield. 2022 was a bad year for bonds, hard hit by the Federal Reserve's interest rate hikes. As new bonds were issued with higher interest payments, the value of old ones fell, causing a global sell-off.
Current US economic growth is relatively stronger than what the consensus expects. And two, inflation remains, especially core inflation, remains relatively sticky. So markets are still expecting the Fed to potentially hike one or two more times, at least one more time for the rest of this cycle before potentially pausing on its current interest rate hike cycle. So as a result, kind of bond yields have risen in anticipation of this interest rate hikes.
When yields are high, the cost of borrowing becomes more expensive for governments, businesses, and consumers. High yields also draw investors away from equities. So, given these rising yields, are there opportunities for investors to reposition their portfolios?
It's important for investors to be selective and to be more defensively positioned in their equity portfolios. Valuations of defensive dividend stocks look quite attractive to us. This kind of defensive dividend stocks tends to be concentrated in better quality companies, and they also tend to be in businesses that are less sensitive to the economic cycle. So at this point in time, where bond yields are, they look relatively attractive to us, especially within investment grade bonds, US treasuries, and US corporate bonds. It's not a bad time to really start locking in some of these yields in portfolios, in fixed income portfolios. As kind of yields are much higher than they were, let's say, 12 to 18 months ago.
Defensive portfolio will be something that is more palatable, meaning I invest in stocks and shares and equities that's generally unaffected by market conditions. And these companies are generally, food, utilities, which is everyday needs.
Keep some dry powder because opportunities will present themselves in the current volatile markets. Not try and time the markets. Perhaps spread your investments out over the next 6 months, 9 months, 12 months by dollar cost averaging. Look at investing some money into bonds and bond yields if you're not exposed to that segment of the market, into T-bills or bonds.
The 10-year Treasury note is used as a benchmark for banks to calculate mortgage rates. 10-year yields have more than quintupled since the end of 2020.
Mortgage rates in the very short term, I think, could remain elevated. But if we do see that recession come through in the second half, over the next 6 to 12 months, and we see that interest rate cut in the second half of 2024, that could subsequently lead to lower mortgage rates. So again, it will be kind of a bit higher for a bit longer, and maybe in the second half of 2024, start to see mortgage rates come down.
Recent moves in the bond market have also renewed fears of a recession, but analysts aren't expecting a severe economic downturn.
We could actually see a recession fairly soon, maybe not this year, but probably in the first half of 2024, that is a possibility that investors should not discount. And along with that, there's a chance that bond yields could start coming down, and the Fed could pivot to a more dovish stance, provided inflation comes down meaningfully below the 3% handle. But we don't see the US economy falling off the cliff and causing a financial crisis. We see a slowdown, we see a recession, but we don't anticipate a deep recession because the fundamentals of the economy are still very strong.
Our base case remains a soft landing or a growth. The risks are to the downside. And it is one of the reasons why we like being in quality and like being in defensive fixed income. Because if that scenario were to play out, quality fixed income will outperform quite meaningfully. You could expect rates to rally. You could expect attractive total return as a result of that rally in the rates.